big focus on power, but let's talk about what's happening here in Europe. Lagarde yesterday talking about Germany bottoming out. Yesterday we saw better wage growth out of the UK. This morning we see inflation maybe coming down a little slower than anticipated. What does that mean in terms of the spread between the Fed and the ECB, the Fed and the Bank of England? Has the market got that one right?
I think the fact that there is a spread makes sense, but I think we're soon ready to pivot to the next stage of the story. So the last few months has been this idea that the ridiculous amount of rate cuts priced for the Fed were never going to happen. Now that even Powell has admitted that he can't cut as much as he wants, we're coming to the final stage of that. Yeah, we have more rate cuts to get price out in the US, so we have yields still have a chunk higher to go in the US. We're not finished that theme, but we've gone through the meaty part of it. I think as we go through to the last stage of that theme, we're going to start pivoting to the idea, hey, wait a sec, maybe it's not just a Fed story. Maybe it's not just a US exceptionalism story. Maybe central banks around the world are going to cut less. Maybe the ECB might get away with cutting in June or something, but they might only do 1 or 2 cuts this year. So I think that we might start seeing a reconvergence of that story at some point soon, and that's going to be about yields in the rest of the world catching up to where the US has already gone.
How does that change the equity story in Europe? Because there's been this catch-up narrative that has been developing. People have been looking elsewhere for the next leg of the trade. If rates aren't coming down in Europe, where maybe there's more of a need, how does that change the corporate story? And then you plug in the FX story as well. How does that factor in?
So higher yields always make it a little bit more difficult for stocks because they kind of raise the discount rate of future cash flows. So a higher yield world is always slightly worse for stocks. But you've got to remember, this is the best type of yield move. It's yields moving higher because the economy is coping much better than expected. And when the economy is coping better, that means consumers are still spending, and that means companies are still making money. So equities will overall cope with these higher yields, but just with extra volatility attached.